Good afternoon, everybody, and a big welcome to the Conquering Chaos webinar. We've got two excellent speakers who are going to help us make sense of the world we're in, and I'm really excited to spend the next hour with you and to, with you, learn from these two amazing people. And I'm going to speak very little because we want to hear from the experts. And to kick us off, I'm going to ask Anthea Gardner, the reason we are all here, to tell us what is the purpose of today's webinar, Anthea.
Good afternoon, Carol. So I believe everyone is wondering how this crisis is going to play out, and lots of people are stressed about their finances, their pension funds and other investments. So hopefully over the next hour, we'll give people some clarity and direction and maybe even a few stock tips.
Excellent. Well, I'm sure, judging by your track record, we're going to get lots of good tips. But we're going to kick off with Dr. Keith Fairhurst, who's going to chat for about 10 minutes. Keith is a director and founder of Unleash Consulting, a high-impact advisory and coaching company that specializes in strategy, corporate governance, performance leadership, leadership development, business turnarounds, and rescue. Keith's company, Unleash Consulting, has been helping people to start businesses, grow businesses, and I think importantly, and this time save businesses for more than a decade. Keith is a professional associate of the Gordon Institute of Business Science. He acts as an MBA and MPhil research supervisor and examiner, and he's very involved with Gibbs's executive development program. So in short, Keith is a very clever person, and we look forward to Dr. Fairhurst, you chatting to us for 10 minutes. Over to you and welcome.
Thank you so much. And Anthea, thank you for inviting me to share what we have been finding during this period of lockdown and COVID. So as you heard, the people that are listening in, one of my areas of speciality is financial distress and turnarounds. It's an area I research in, it's an area I'm fascinated by, and it's an area of the economy where I engage with companies in many discussions. So what I'd like to do is I will share my screen because it helps if we can put it into some sort of picture what we're talking about. So as Anthea said, we're all sort of asking questions like what's going to happen once lockdown had ended? What is it going to look like? Well, the truth is nobody really knows, and not dissimilar to a virus that might hit your computer, you may have to reboot your business. So we've taken this view and said, well, if you've got to reboot your business, what lessons can we learn from business rescue, which is something that myself and my colleagues at Unleash have been doing since 2010, so the last 10 years. And with that in mind, we started talking to many of our clients, many business leaders, many business managers, and trying to make sense of what we were observing. And that is part of conquering chaos. So the first step in conquering chaos is to make sense of it. And right now, I would like to just share with you some of the things that we have discovered in these conversations. So the first thing is that we are absolutely convinced that during COVID-19, whether it be lockdown or once lockdown ends, any business organization can be classified in one of three ways. And it all starts with what they looked like in pre-COVID. We call it a broken record. So a broken record, and for those of you that don't remember vinyl long-playing records, they're those black things that you put on a turntable and listen to music from. But it applies equally to a CD or even to a flash drive. When it's in its sleeve, you cannot see that it's broken. The distress is hidden from outside parties. So for the outside party, it still looks okay, but in fact, it's not. The second one we identify is what we call the balancing act. This is a company that's walking on the edge. They might be delivering sort of a positive return, but it's not great, average performance or below average return. And they tend to stumble from month to month or quarter to quarter or year to year without making any real impact. And they need things to go their way in order for the company to survive. We call that the balancing act. And then the third category is an organization that's fundamentally healthy, may have been adversely affected by COVID-19, but in fact, prior to COVID-19, it had decent returns, was well managed, and it was a healthy organization. So now we look at what do these organizations look like post-COVID. Well, the broken record is a broken record. It doesn't matter how much glue you use, how much sellotape or press stick, you cannot put it back together so that it plays like the original. I'm afraid in some instances, we're going to see organizations that were struggling before COVID-19, and it is unlikely that many of them will make it back post-COVID-19. The balancing act is an interesting one because this is a rude awakening. One of the things that we've found in Business Rescue over the last 10 years is the first step in turning around a business is recognizing there's a problem. And denial is so prevalent in underperforming businesses. So COVID-19 may, in fact, for some organizations be a blessing because it's shocking them into looking at their business. So it's a rude awakening. And either that business will achieve some form of stability or they will fail. And much like this balancing act here on the top of a building may have a long way to fall. And then the third one is a fundamentally healthy business. And this one requires a case-by-case assessment. Now, I've had an interesting conversation in recent weeks about the airline industry. And I think it was Forbes issued some sort of paper recently where they suggested that airlines will now require a 4-hour check-in time. Now, if that happens, the business model may no longer be valid. So a fundamental question to ask for any business that was healthy prior to COVID-19 is whether the business model that existed prior to COVID-19 will exist beyond COVID-19. People that are prepared to predict that, I think, are very brave. And I would say that one needs to be very careful when you're thinking about business models. And certainly for airlines, if you have a 4-hour check-in, then short-haul flights become very difficult to be justified. So we think any business can be classified into one of those three categories, and that's what we think at a high level, what they may have looked like pre-COVID and post-COVID. But how does that help you? So if you're trying to assess a business or you're running a business or managing a business, how do you make sense of this? So the next thing we said to ourselves was, how do we make sense? So we said, well, this might look like a little busy picture to you, but bear with me because we will do it in pieces. The first thing is we have to think about individual people and people focus. The next thing is the organizational, and that's the vertical scale. It goes up and down there. In the horizontal scale, we're looking at today to what we call a near-term horizon. Now, for any of you that have been on a ship at sea, you can only see as far as the horizon. That's how far you can see. And of course, if there's mist or fog or rain, you can't even see that far. So you can think of this as the horizon. It's how far you can see and how far you can, how far the distance is that you can make out features. Beyond that, we move into more uncertainty, and prior to that, less uncertainty. So let's start in the top left-hand quadrant. The first thing is, as leaders, managers, and as individuals in our own lives, we have to learn to cope. So it's about coping skills. How do we deal with not leaving the house? Well, you know, people who previously didn't know what Zoom looked like, didn't understand emails and preferred to print everything out, have suddenly become tech wizards. So that's resilience. The resilience has got three parts to it. The first part is taking stock of reality, so accepting the reality The second part is being creative and inventive. And the third part is about serving some purpose greater than yourself at that moment in time. So remembering the purpose is important. So for us as leaders, we have to do that, but we also have to think of the people that we're working with. Now, in week 1 of lockdown, we asked many business people what was occupying their minds. Every single one of them had the same answer: our people. What are we going to do about our people? How are we going to keep them employed? How are we going to pay them? They were worried about their people. Interestingly, in week 2, once they'd got their minds around how to help people deal with lockdown, their people and themselves, they went on to what is informed this quadrant here, which is how long can we survive? What's our survival plan? Now, we call that lengthen your runway. We have no clear idea at the moment of what the economy or industries may look like once COVID-19 lockdown is released or relieved. Whether we go to level 3, 2, 1, whenever that might be. We actually don't know. So we need to lengthen our runway. We need to do everything we can to survive as long as we can, so that we can, in that time, work out what it takes for our business to get airborne again and be able to operate well. So that led us to in week 3 or 4, we started talking to companies about what they were doing. Many of them had worked out. In fact, I have one client who in week 1 worked out exactly how long they could last. And they did their financial survival plan in week 1. And they had it in action by week 2. There's 2 main features before I move on here that I encourage you to look at here under financial survival plan, whether you're doing this for a business or for yourself personally. The first thing is, how much cash are you burning every month or every week or every day? But it's basically how much cash do you need? Then the second thing is, under current trading conditions or current income conditions, how long will it be before you run out of cash and cannot afford to pay the costs that you're incurring? Those are the 2 most vital ingredients. For the accountants listening, you'll probably say, but that's a cash flow. Absolutely, it is a cash flow. That is the accountant's way of formulating it. But if we're talking survival, think of it in terms of how much cash am I burning? How much cash am I getting in? Because that will be the determining factor. Once you've done that, you need to start looking at the scenarios and the agility. How are we going to survive beyond this crisis? And that is about being curious. Speak to customers. I have one client who did this in week 1 and week 2. In week 3, week 2, they started talking to their clients and saying to clients, what are you seeing? What are you experiencing? This happens to be a logistics business. In week 3, this client then started sending suggestions to their clients saying, when lockdown ends, here are some suggestions about how you can contain your costs in terms of logistics, how you can use my services more efficiently and effectively. So from talking to them in week 2, by week 3, he had started giving them suggestions on how they could use him post-lockdown in a more cost-effective manner. So a couple of things, and he didn't discount. It was still at acceptable margins. So there's some suggestions. So I was asked the question the other day, what is design thinking? Because it's a bit of a buzzword. Well, design thinking is a defined methodology to help organizations with innovation, but putting humans at the center. So it's about putting your customer at the center of your thinking and innovating around your customer as opposed to innovating around yourself or your organization. All right, so we move to this last quadrant. So this last quadrant is important for individuals and organizations. We need to repurpose for the future. I had a conversation this morning with a musician. He's a very successful international performing artist. His revenue stream has gone to zero. He's had to take up teaching, and he's at heart, he's at heart a performer, not a teacher. But he's having to repurpose himself. He's taking his skills as a very talented musician and composer, and he's now starting to say, well, how can I use these skills to lengthen my runway and go beyond the COVID crisis? So that's this quick sense-making matrix on super fast forward. And before I end and hand you over to Anthea, who's going to elevate the conversation to the market and the stock market predominantly, let me try and just give you a couple of simple takeaway lessons. The first thing I encourage you to do, whether it be in your personal life or in your business, is face reality. Take stock and ask difficult questions. I have one client, took them 6 weeks to work out how long they could survive on their current resources. And the reason for that is because they had to ask difficult questions about whether they could afford to keep all their staff. And their staff have been with them a long time. And this is hard. It's very hard because they feel very close to their staff. But unfortunately, in this instance, they probably will not be able to keep all those staff and survive. So that delayed them from facing reality. They eventually got there, but it was a hard road for them. The second thing I encourage you to do, both personally and in your businesses, is lengthen your runway. Look for underutilized assets and non-productive expenses. So if you've got underutilized assets, ask yourself, how can I turn them to generate some revenue? Or can I turn them into cash so that I can use the cash to fund my runway or to pay off debt? And then if you are incurring non-productive expenses, cut them out. Go through your income statement line by line and ask yourself, is this essential? Can we do without it? At this point, people may be inclined to say, well, you know, we can increase our debt levels because fundamentally we're healthy. And yes, you may be fundamentally healthy and have a good solvency ratio. And I want to just remind you that you underwrite liquidity with solvency. So if you borrow money and you increase your debt level, you're underwriting that with your solvency. The last point is embrace innovation. Be brave, be curious, talk to your customers and try new things. Those are the three most significant things that we have found in the last 7 weeks from our many, many conversations with clients and business people. I don't know if I've taken 10 minutes or gone over, but I thank you so much for inviting me, Anthea. And if I can hand over to one of the hosts, then I will do so. And I wish you all well during this very difficult time we're experiencing in the world. Thanks so much.
Thank you very much, Dr. Keith. And I think based on some of the practical tips you gave us, it will help us as we make sense of the future. So a number of you have been asking questions. Thank you for that. Please continue to ask your questions in the Q&A. And Anthea, I suspect, will be covering many of your questions because she's well known at gazing into a crystal ball. So she's anticipated many of them already. But after Anthea's presentation, there'll be an opportunity for Anthea and Keith to answer your questions. So don't be scared to ask those. This webinar will be made available. We'll email a link to all attendees later today, and it will also be available on the Easy Equities YouTube channel late afternoon, early evening. But without any further ado, I'd like to introduce Anthea, and this is an interesting thing because it's a little bit of how long is a piece of string, where to start. So I think most of us know that Anthea is head of Cartesian Capital and a clever asset manager. She's on Cliff Central, where she presents a show called The Money Shot, which talks both to her smarts and her sense of humor. And in fact, she's not only there, she's on CNBC and just about everywhere that anybody needs a clever comment on finances. And today she's on this webinar. But she's also a sushi lover, a legendary wine drinker. She is a brilliant cyclist that you might not know. She's the author of a book, How to Make Your Money Work for You. She's chair of the Early Childhood Foundation. And yeah, I'm probably leaving out about 100 things, but most importantly, she's a person who's passionate about money and helping others make it work for them. So Anthea, we're delighted that you're with us, and we really look forward to your wisdom. So thanks for having us, Anthea.
Oh, thanks for that fabulous introduction, Carol. I'm going to go straight to sharing my screen. Second here. And I'm just going to get straight into it, right? So there we go. So this is just one of the many corona memes going around at the moment. And sure, we don't have a crystal ball and we can't see into the future, but unlike the coronavirus, stock market crises are not new. And we do treat us out. When you say, where do you see yourself in 5 years? Well, very difficult to answer. Let's look at a couple of them. I mean, we don't even have to go too far back to see what three, the Russian debt crisis of 1998, the dot-com bubble of 2001, and the global financial crisis of 2008. The first one, the Asian contagion and Russian debt crisis, happened between 1997 and 1998. The Asian crisis or contagion was actually a mini crash, so it wasn't that big a deal. The market fell 26%. However, that was hotly followed by the Russian debt crisis in August 1998. That's when Russia was unable to maintain a fixed exchange rate due to declining productivity and a fairly persistent budget deficit. Sound familiar to anyone? And eventually the government defaulted on their debt. The graph you're looking at is neither the Asian market or the Russian market. It is in fact the all-share index on the Johannesburg Stock Exchange. Asian contagion, by the way, is also known as Tom Yum Goong crisis. And as Carol mentioned, yes, I'm an absolute sushi and Asian food lover. So if you know this, you'll know that Tom Yum Goong is kind of the quintessentially hot and spicy Thai prawn soup. This caused a global mini crash. It started on the Friday, and by the Monday, it had spread to the 26% from peak to trough. Then we had a little bounce, or more than a little bounce. We recovered quite nicely before markets got really nervous again and predicted the Russian economy was not our benchmark index fell 42% between April and September of 1998. Then the recovery. Over the next 6 months, the market returned 55%. To those of you that were able to sit through the volatility and resisted the urge to withdraw, to those who sat through it and were resisting the urge to withdraw their investments, of course, they made that 55%. Those that sold out basically crystallized their losses. Post the Russian debt crisis, from 1998 to May 2000, the market was up 169%. So there you were. Just been through the Tom Yum Goong mini crash, then the horrible Russian debt crisis. 4 years later, you're up 169%, assuming, of course, that you didn't sell your investments. Then came the dot-com bubble. That took 2 full years to burst. So you'll see my little arrow down the middle of the page. That's the initial shock, which came in September 2001, when the market fell about 20% in just a couple of weeks. So it was fairly hectic. And then it bounced, looked quite strong for from May 2002 to May 2003, there really was no holding back. The market plummeted. But not even a year later, by February 2004, the market had recovered 51%. So here's a nice little peculiarity of working off a lower base. You don't get to exactly where you were pre-crisis to actually make back the money that you had lost. Or I shouldn't say with the money, you do need to get back to where you were to make back the money you had lost, but to make more money than the decline. All I've done here is extend the previous graph, which ended in May 2005 to July 2007. So now this graph now ends July 2007, and the growth in assets from the actually crashed, including the 37% crash, 56%. Don't worry, you don't have notes. I'll summarize afterwards. Okay, the last one, before the current crisis, also my personal favorite. If you want to know why it's my favorite, you're going to have to at least buy me a coffee or a glass of wine. Tell you all the stories about trading what Warren Buffett called finance weapons of mass destruction, and what we in the finance world simply called derivatives. Also, I think by now all these blue lines, arrows are at different time periods must be messing with your head. So just bear with me. I promise I'll summarize. The global financial crisis panic was spectacular. Global markets crashed quickly, contracting by 47% in 3 months. South Africa took a bit longer. We fell, as you can see from my graph, 45% from May to November in 2008. So about 7 months or so. This crash was driven by banks that borrowers with poor credit records, which in fact turned out to be rather dodgy debt. So it was unlikely to ever be repaid. And the entire financial system was at risk. As you should know, the banking system is built on trust. And when this trust started wavering, regulators moved quickly to overhaul the system, because the fear at the time was that the market cannot be trusted and that it will never be in a position when anyone can trust it again. This time, the recovery was longer. It took a full 2 years before we got back to the pre-crisis levels. I've been asked by Carl to turn off my video, so I'm just going to do that very quickly. If you give me a second. I can't seem to find a way to do it. Maybe that is it. By now, you're surely getting used to me doing this. All I've done is extend the previous graph from where it ended in April 2011 to December 2019. Pre-crisis, so before the drop, the 45% drop, to peak, we gained 81%. And this is to January of last year. And this is, don't forget, the all-share index. If you had invested in the trough at like the bottom of the global financial crisis through to December, you would have made 229%. So in summary, the Russian debt crisis peaked to trough. The drop was 42%. Recovery took 7 months, but it was 55%. The dot-com bubble fell 37%. Our market at least fell 37%. Recovery was 51% in 11 months. The global financial crisis, the market in a very short space of time fell 45%. But recovery was 75%, and it took 2 full years to get back to where we were. So have a look at this horrible graph, because this is your reality right now. From January of this year to March the 16th, the all-share index fell 35%. This means that on average, the shares in your investments and pension fund lost 1/3 of its investment. I wouldn't normally recommend taking investment advice from non-professional financial advisors, but I do like what the Canadian ice hockey phenomenon that is Wayne Gretzky said. Skate to where the puck is going and not to where it has been. Because look what happened while you were in lockdown. From the 16th of March to last night, I updated this graph last night, we've already had a 37% bounce in the all-share index. So imagine you'd sold out your investments on March the 23rd and crystallized your losses. Unlucky for some, you would have missed out. And the question remains, where to from here? Back to old Wayne Gretzky, because even if you don't perfectly end up where the puck is, at least you're moving in the right direction. And he also said, I believe he said, you miss 100%. So let's talk about what's happening at the moment. And this is pretty much what my news feed looks like. For the first time ever, we've seen oil futures trading in negative territory. The South African Reserve Bank made 2 emergency 100 basis points interest rate in short succession. And for the first time in my memory, implemented quantitative easing. In the US, they have had 36 million people apply for unemployment in the last 8 weeks. Back home, Edcon has gone into business rescue, as has Comair, which operates Kulula and British Airways, as has Phumelela Gaming, and I haven't even mentioned the obvious one, SAA. Going into business rescue, we're seeing companies like Barlow World and Brait, who owns Virgin Active, and the Spur Group, who also own Rockamama's and John Dory's, talk about cutting salaries and conditions. And then, of course, there's always the bright side, right? On the flip side, there are companies like Tencent, the Chinese online gaming business, which is a massive contributor to Naspers' earnings, who because everyone in lockdown is playing a game on their phone or computer, such as Player Unknown Battleground, or like to the very cool In the Know PUBG, as it's called. I'm kidding, I've never played it. I'm not even close to cool. I really have to rely on my analysts here. And then I can't even mention how smart the Easy Equities community, can't not mention, I should say, how smart the Easy Equities community is, because they read over the weekend saying that Easy Equities is seeing a 200 to 300% increase in mainly young investors during this time of corona crisis. And here's another interesting one. Morgan Stanley, who I used to work for, by the way, and who I do have the utmost respect for. I mean, I know some of those people, they're very smart and intimidating. They recently said, bottom out in May. In other words, what we're seeing now is the worst it is going to get. And they think from here, it's a one-way bet up. I'm not sure. I'm not sure I can say with absolute confidence that that is what I believe. In fact, now might be a good time to remember what Warren Buffett said. Forecasts may tell you a great deal about the forecaster. They tell you nothing about the future. So good luck to Okay, so what does all this mean? And that's a lot of information, right? So for a start, in 2008, think about this. You could have been invested in any share or almost any share on the stock exchange. You could have thrown a dart in 2008. You would have made money. And at the risk of repeating a rather worn phrase, I think this time is different, not on the good side though. There are shares like Group 5, which is a construction company, which has been listed on the JSE for 46 years. And even though they were struggling post their great couple of years around the 2010 World Cup event, you know, when they were contracted to build the Moses Mabhida Stadium, COVID-19 really has been the straw that broke the camel's back. And you can imagine there's been growth for 5 years in South Africa. And so, of course, if there's no growth, there's no construction. This company is now in business rescue and delisted from the JSE. So if you were invested in shares in Group 5, right? Then there are companies like Vodacom, who reported results last week, bang in line with consensus, not a very exciting set of results. And actually, their results haven't been very exciting for a while now. And somehow it just seems a safe place to put your money. I mean, how dull is this? Headline earnings per share was up not even 1%, 0.9% on a normalized basis. And it's quite funny to hear their CEO, Shamil Yusuf, once again, he did this thing in the presentation where he made everyone listening feel like flat earnings was an outstanding achievement. Yeah. So for the record, Vodacom earnings have pretty much gone sideways for the last 7 years. But at least, here's an interesting fact, that they're still managing to pay a dividend of R8.45 per share. And in this environment, I think share price and R8.45 dividend is about 6% yield. So that's not terrible, considering you're probably only getting 2 or 3% in the bank. And also their balance sheet is in pretty good shape. Their net debt to EBITDA is 0.7 times. So even if you don't know what that means, just take my word for it. It's good. And actually, just group 5 and Vodacom aside, right? What I really want to talk about is consumer spend. I mean, because I think that to understand how and if our economy and where to be invested, we need to understand consumer behavior. 60% of the South African economy is made up of consumer spending. That's you and me and how we spend our hard-earned money. So some things we need to buy, like food and electricity and gas, and maybe some new clothing. Other things, like a car or restaurant meals. But let's be clear about this. All retailers are not created equal. And in our lockdown, there are some retailers, even if they were selling essential goods or products, they often only could offer half of their product range. And we'll have a quick look at Pick n Pay, who reported results on Monday, who sell food, clothing, and alcohol, but are not allowed to sell all products during. And actually, when you think about it, even retailers who should be able to sell everything, are now sitting on end of range summer clothes, because nobody in South Africa is going to buy anything that they haven't sold, or winter clothing stocks that was ordered last year already that people just don't have money to buy as they come out of lockdown. People are more worried about, you know, whether or not they're going to have their jobs and whether or not their salaries are going to be cut. And I don't think they'll be shopping at Gert Johan could see, maybe Woolworths or maybe even Mr. Price. And another thing, if you're working from home, do you buy another smart tailored suit or a pair of comfortable track pants? I mean, so even the non-discretionary and the discretionary spend have their peculiarities. So I promised we'd take a quick look at the Pick n Pay results. This is quite a nice summary. This slide, in fact, is straight from the Pick n Pay results presentation. And if you want to, you can find it on their website and trawl through all 64 slides. But what we're looking at here is that profit before tax grew 15.2% in South Africa and 6.5% for the group as a whole, which almost makes it irrelevant when you see that the headline earnings per share, and this is the real number for us as shareholders, like the headline, the earnings per share number is what you and I basically are making on that money, because that's how much effectively the impact of those turnover growth or the profit before. These results, that number decreased by 0.6%. I particularly like this slide actually, because it's interesting. It's stockpiled before the lockdown, so bleach and vodka sales were up 138% and 104%. Yeah, and then toilet paper, of course, everyone stockpiled that. And this is what's happening during lockdown. So right now, clearly we have a lot more budding artists in our society than I suspected. Paint and brushes up almost 300%. Oh, hang on, and no judgment here. 91% increase in non-alcoholic beer. How desperate do you have to be? And here's a bit more arbitrary information. During lockdown, Pick n Pay shoppers are spending more on Tuesdays and less over the weekend. Like, talk about herd mentality, right? So does that mean that everybody thinks they shouldn't be shopping on the weekend, but Tuesday's probably a quiet day, so I'll go to the shop, and then everyone goes to the shop? I mean, to be honest, I can probably attest to that. I'm probably one of those people who doesn't want to catch the coronavirus, and so actually I and just kind of keep my time there to a minimum, which means, of course, that I'm now having to spend more on average per basket. My baskets are bigger than when I previously would just pop into the store every day or every second day when I needed something fresh. Pick n Pay's observations of how consumer behavior for consumers shop regularly and across brands Now they are shopping less frequently and buying more at one time, as I was saying about myself. Clearly a lot more time spent online, and therefore Pick n Pay has to change its key advertising channels. And then on the right-hand side, spend on discretionary items remains under pressure. Because most of you are South African, is that actually, even before the coronavirus, things were quite difficult and people really were worried. And so they actually going out and spending as much as previously. Sure, that's Wednesday lunchtime. And so I guess the real question, where is this leading us? So if we're looking for companies that will survive this crisis, we also with leadership, with vision, right? I quite like what Jeff Bezos told shareholders in a recent results presentation. And it's more than just the fundamental, you know, if you're a share owner in Amazon, you may want to take a seat because we're not thinking small. That's brave, right? That's very Elon Musk-esque. But it's not just the fundamentals. At their last quarterly results, they announced net sales increased 26%. So these were results to the end of March of this year. 26% they grew net sales to $75.5 billion. And operating cash flow increased by 16%. I mean, those are phenomenal numbers. This crisis is actually demonstrating of Amazon's business like never before. And so, of course, they are definitely going to make it into my top picks list. Along with a couple of other companies, the share price has been overdone, where the share price has been overdone, or they have strong balance sheets, and we trust they'll survive when lockdown ends. I mean, so I guess this is a good mix of speculative and companies where I'm fairly confident. So Sasol, for example, I mean, I really think that the share is worth much more than where it is currently trading. But with the demand in oil, the oversupply, lack of storage, even though we've seen a small bounce in the oil price, it may be a while before oil recovers sufficiently for Sasol to become profitable. So you do really still have that risk. And on top of that, Sasol have said they may potentially have to do a rights issue to raise more capital. Is the company going to fall over and close its doors? Probably not. It might be a bumpy ride though, let me warn. It's like Naspers, which is 33% owned or has a 33% shareholder, Chinese online gaming company Tencent. Tencent recently reported that revenue growth was 26% year on year. And of course the share rallied, as you saw in my previous graph, it hit 2-year highs. But in the background, Naspers has come under quite a bit of pressure during the sell-off and is currently trading at a 50% discount to the value of its underlying investments. This is the widest discount we have ever witnessed for Naspers. And so even without Tencent, where the group is priced now, it still has in its own right established quite a nice, I guess the word is attractive investment portfolio in online classifieds, food delivery, and fintech. Then there's a lesser known business, Transaction Capital, which owns South African Taxi and is basically a taxi financing business with a couple of other ancillary services, including insurance, group buying businesses like tires and fuel, where they can, as a group, negotiate cheap prices for the taxis. And then they also have a debt recovery business. So undoubtedly, the COVID-19 crisis will cause some of the operators to come under pressure. I mean, they're just not enough commuters to make it worth their while. But this should be somewhat negated by the reduction in the local fuel price, because Transaction Capital as a group will look after their drivers. And then over the last few years, SA Taxi has built quite a strong, nice moat, as Warren Buffett would call it, you know, like a competitive moat around their business through sort of vertical integration, data collection, taxi routes, and all this. And I think that has probably set them up quite nicely to weather the storm and come out of lockdown. Then there's another speculative trade, MTN. made it fairly clear to us that they were in a very strong position. But I think as emerging markets come under pressure, the currencies come under pressure in the countries that MTN operates, particularly in the oil-dependent countries like Nigeria and definitely a dividend risk, you know, where they potentially wouldn't pay their dividend. A trading update last week sometime, and they showed that they managed to grow service revenue by 17.4% year on year. Now compare that to Vodacom, who grew their service revenue by 5%. So it seems like they can do much better than Vodacom, that I was speaking about, your kind of safe ship in the harbor. But yeah, MTN still for me falls into that speculative bucket, just because of their exposure to Nigeria and Iran and emerging markets in general. Then there's FirstRand. It somehow always ends up in my top picks, like for the last years. And by the way, it's not just because I work for RMB, which is part of the group, but I think just year after year, this is a company that delivers return on equity in the low to mid 20s when other banks are in the teens. I mean, so FirstRand certainly isn't protected from the young upstarts like Time or Capitec. Capitec, unbelievable. There's an interesting one, because they've been able in the last, I don't know, year probably, to grow their client base by 200,000 new customers every month, which of course means that those customers are leaving your other traditional big banks and coming to Capitec. But the reason I like FirstRand is because actually they're quite conservative in their approach to lending. And even though their provisioning for bad debts is quite conservative, I do that their client base will be less affected by the crisis than, say, a Capitec. And for business you may not have heard of, Synchrony Financial. It's the largest private label retail credit card business in the US. They reported about a week ago, I think, their first quarter results. Purchasing volumes actually grew by 6%. And even though they had to write off debt, their write-off was actually lower than last year. So they did say, kind of going into the second half of March and April, that volumes had declined significantly, anything between 26 and 35%. But they do believe that this decline has stabilized. And quite honestly, this share price is ridiculously cheap at just 1 times tangible book value and a historic price earnings ratio of 3.8 times. So it's almost hard to ignore it, even though spending power in the US has declined. I think you could probably out of this share price when things do normalize. Sure, I've spoken a lot of analysis, a lot about listed companies. And before I finish, I'm almost done. I need to show you this graph. It looks a bit academic, but it's actually quite simple. All I'm doing here is plotting the risk associated with an asset class versus the expected return based on historic data, of course. I've got my y-axis, we've got the return, and on the x-axis, the risk measured in standard deviation, or in terms we understand, basically it's volatility. For example, cash. The nominal amount of cash stays the same. You're not going to earn yield or a return on the cash, on your cash in the mattress, right? What will happen, of course, is that your 100 Rand today will buy a lot less next year because of inflation. And I think, Carol, I think we might have to have another session, because we haven't even started looking at money market, term deposits, bond yields, government bonds, and investment grade bonds, let alone private equity. But basically what I'm saying in this graph is that the higher return asset classes do have higher risks associated with them. So kind of decide where you want to be. And also remember that diversification is key. And so just a quick summary, my takeaways: markets do recover. Diversification is an essential strategy. As Keith said, face reality, lengthen your runway, and embrace innovation. And
thank you very much, Anthea. We had a couple of challenges with the connection there, unfortunately, but it was amazing. Once you got to your predictions or your analysis or your top picks at the end, it was a bit better. So there was obviously the gods smiling on us. So thank you very much. So we're going to answer a few questions, Anthea, but I just want to repeat to everybody that we'll mail the presentation to the people on the webinar, and it will also be available on the Easy Equities YouTube channel. And Anthea, I want to put you on the spot only because I can, and also traumatize all my colleagues, partly because of the challenges we had with your connection, and partly because there are so many questions. And Anthea, before the session, said to me, what if there are no questions? And the problem is, Anthea, there are so many great questions. So next week, Anthea, we've found people are quite engaged, half an hour in the mornings. Can we twist your arm 8:30 to 9 o'clock every morning next week to chat some of the stuff you didn't get to?
Probably not, I'm afraid. But can we talk about this?
We'll keep people posted. I think Anthea needs to, her arm will be twisted. Cool. So Anthea, I'm going to ask you a couple of questions, just conscious also of the, yes, of the connection. So you didn't cover anything about some metals, gold, silver, rhodium, and there are a couple of people that have got questions around those. Any thoughts on silver, gold, and any metals we should be investing in?
I quite like my list saying gold is for, it's not true. It's because it's such a great hedge. You know, when things go pear-shaped in the stock market, everyone runs to what we call safe haven assets, and definitely gold is one of them. So the question, I think, really is, gold has run so hard. Is it too late to be invested in gold? And I don't actually think so. It's very difficult to be invested in a gold ETF or a gold unit trust or just pure gold. You kind of almost want to be invested via the use gold, and even all companies are not created. So you need to look at the companies very carefully.
Great. And then I'm going to try one more question, and then we're going to end it just because of the connection. But I was wondering if you could chat to a couple of questions on real estate rates and property. You spoke a little bit about construction, but any thoughts around property and property investments?
Yeah, so a lot of listed retail companies at the moment, normally shareholders, are now struggling because as landlords, companies are telling them that they want to pay less rental in the supermarkets or the shopping malls. Unfortunately, that's a real problem. And because the REITs have fallen so far, they look like great dividend yields. I mean, I saw Reader, I think it was on like post more than 40% dividend yield, which sounds great until they don't pay a dividend anymore. So when they don't pay their dividend next year and the share's fallen so hard, then it's really difficult.
Absolutely. Great. So Anthea, we're going to call it quits there. So I want to repeat to people that we're going to twist your arm and have you on for a couple of sessions where we can hear you better and get some of your wisdom. But thanks very much to you and Keith for taking the time. And I think particularly useful were the top picks that you've got. And maybe as a reminder to people, those aren't thumbsucks. When somebody like you, and particularly you, gives us those top picks, it's very much based on research and not just reading a couple of tweets, but real research. And so I think that's really valuable that we can get those top picks from you. So a big thanks. And we will keep everybody posted about future sessions and make sure that you get the benefit of Anthea as we navigate the markets and make some sense of the chaos around us. So big thanks to Keith and to Anthea and to everybody who joined us. Have a good rest of the afternoon.